Everyone, this is for my tax accounting course, ACC 204. Quick video this week. Based on the feedback, I haven't had too many questions. It seems like, for the most part this week, we're in module 9, chapter 10. In chapter 10, we talk about deductions for self-employed individuals versus employees and some other deductions and losses for individuals or W-2 income tax filers, right? So looking at that, there were some topics we talked about. For example, if you're a self-employed individual and you have a business expense, the meals are limited to 50% of the total cost of the meal. We talked about limitations for medical deductions for individuals that are filing on behalf of themselves and their dependents for medical expenses for deductions. There's a 7.5% AGI floor. The expenses need to exceed 7% of AGI before you can take any of the deductions. So that was another limitation that we talked about. We went over state and local taxes, which are capped at $10,000 a year, and some of the calculations there that we can use for deductions. There was also a topic of selling a home. If you sold a home, and who gets to deduct the taxes, the property taxes, the buyer or the seller, regardless of who pays. And if the home's sold, which is going to happen most of the time, anytime other than the first of the year, there's going to be some sort of apportionment between the two individuals, that the buyer and the seller. And we talk about the calculation of that. So those are some of the topics that we covered this week. Like I said, most of the homework, especially the first half, everyone did pretty well on, and there weren't many questions there. So this is a quick video, but I wanted to talk about a few things that came up. First, why don't we go into one of the deductions that we talked about, which is the real estate taxes, and what happens if you sell a home as a seller and buy it as a buyer. Who gets to deduct the real estate taxes? And the answer is, it depends on the answer is that you apportion it based on the amount of days owned. So we have an example here with Tabitha sells real estate on March 2nd for $13,600. The real estate taxes are $15,680. So Tabitha, when you calculate the number of days, right, which if we go down to the bottom here, just so I don't have to calculate as we're talking, because I just had it up a second ago. Let's see, where did we go? Yeah. So Tabitha, if you calculate March 2nd, it comes out to roughly, I apologize. It comes out to 60 days. For some reason, I'm calculating March 31st in my head. It comes out to 60 days. If you divide that by 365 and multiply by the real estate taxes of $15,680, then you come up with $2,578. Ramona then would have had 295 days, right? Sorry, take that back, calculating wrong date again. It would have been 305 days divided by 365. You take that percentage, multiply it by the taxes paid of $15,680, and Ramona would be allowed to deduct $13,102. If we go into the basis, right? So if we go into the basis for the property, right? If we look for the amount realized from the sale, so the basis on the sale, Tabitha would have realized on the sale $316,178. Ramona would have had a basis in the sale of $316,178. So the question might be why, which is what came up before, and the answer is it has to do with the 2,578 number, right? So the basis for Ramona, who's the buyer, Ramona will only pay taxes not for the whole year, but is just paying taxes for the portion there. So Ramona is going to add to the basis the amount of taxes that Ramona didn't pay, and that would be the 2,578. So the basis would be Ramona's cost, which is 313,600, plus that apportionment of taxes that went to Tabitha. So the basis is 316,178. So just know that if you're the buyer and you're looking for your cost basis, it's going to be the cost of the real estate, of the purchase, the asset, plus the apportionment that went to the seller on the real estate taxes if it's real estate. So that would be Ramona's cost basis. So there was a question there on that. Just going down, looking for another one. This was a big question here. There's a lot of information. My one advice is when you go through the questions on a piece of scratch paper, write down some of the key facts, because it's very easy to get lost in all this information. But basically, we have a taxpayer named Susan, who has a daughter, Beth, and Beth's father, Ed, right? And there's all these expenses related to medical expenses that the question is, what is eligible for a deduction? So the first question is, Ed, who had several expenses in here, excuse me, do his expenses get to count for Susan's deduction, since Susan is the filer? We know that Beth is a dependent of Susan, but the question was Ed, right? So when we go down below, the answer is yes. And the reason why is because the gross income test for qualified dependents is not applied when determining the dependency status for medical expenses. So when you look at the medical expense deduction, if you're trying to figure out if you have a qualified dependent, which Ed would have to normally meet a gross income test for some other deductions. For medical, you don't need to meet that the gross income test. So Ed would automatically be included, right? So then the question is, well, what of these total medical expenses would be included? And the answer is it's really the majority or all of them, right? Because surgeries, medications, those are all medical expenses. Beth was advised by a doctor to enroll in a special school that catered to her treatment. So that gets to be included. Anytime a doctor, recommends, prescribes, those expenses get to be included. A lot of the nursing home, all these costs get to be included as well. But in the example, there was this piece down here where we have this filtration system. So Susan she has allergies, and the doctor recommended that Susan install a filtration system for $6,500 in her home. That was the cost of it, right? So in addition to the cost of the installation, there's an increase in utility bills because maybe the filtration system requires obviously more energy. And then there's an additional cost of $360 for the appraisal. So the tax rules are that in order to deduct the piece of medical equipment that was installed in the house, we need to determine if it's installed in the house, it's affixed to the house. Does it increase the value of the house? So Susan got an appraisal. The appraisal came back that the filtration system increased the value of the house by $2,200. So if we go down to the bottom, the quick answer is that we get to include pretty much all the expenses related to the medical care, right? Almost all the expenses related to the medical care. So the question was, without looking at the floor, the 7.5% floor for AGI to meet, what's deductible, what's the total qualified, what's the total qualified medical expenses, and all these things are going to be, all these things will be in here. The big difference was the deductible cost for the filtration system. So Susan was not allowed to take the full $6,500 deduction because there was an increase in the value of her home as a result of installing this this filtration system. So the rules for tax purposes are that you would take the cost minus any gain that you would get in the fair market value of your home, and that's how we get to the 4,300. So most students had these qualified expenses correct. The questions came on this right here, the difference between the cost and the increase in the value of the home. So you're limited to the deduction from the cost minus the increased value of the home. You are allowed to include the increased utility bills, but you need to exclude, you're not allowed to include, you need to exclude the appraisal cost. That's on your own. So the total cost for the medical was $38,370. So I think that answered most people's questions there. We have another basis question, right? So here, Alicia sells a house to Rick on June 30th. Before the sale ends, Alicia pays the real estate tax of $4,380 for the whole year. For income tax purposes, the deduction is apportioned as followed: $2,160 to Alicia, $2,220 to Rick. And the reason for that is because at the time of the sale, regardless of who pays, at the time of the sale, the buyer is now entitled to take the deduction for real estate taxes. So even if the buyer doesn't pay the real estate tax, they get to take the credit for the deduction at the point where they buy it going forward. That's the apportionment that we talked about previously. However, if the buyer didn't pay for the real estate taxes, then there'll be a reduction in the basis of the residence. So we're reducing the basis, the cost basis of $300,000 by the $2,220 that went to Rick. So that was another common question we got there. There weren't too many questions on the state and local deduction, so we can probably skip that one. There weren't many questions here. And then I'll cover this briefly. So there was a question, and this is another very wordy question, right? Lot of answers to put in. But let me cut right to the important elements of this question. So we had a question on charitable contributions. Charitable contributions are deductible, right? As long as it's a qualified charity, a qualified charitable organization, you're allowed to deduct, in most cases, the fair market value of the donation. The rule, though, is that if you're donating anything other than cash, if you're donating a asset that has value, things like land and stock and gold stock, things like that. The rule is that if you hold the asset for less than a year, you're not allowed to include the fair market value. You're only allowed to include the cost. So the first question was, what's the charitable contribution deduction? For all these items, you're allowed to use the fair market value, except for Blue Corporation stock, because you held it for 8 months. So because you held an asset other than cash for less than a year, you have to include the cost basis. You can't include the fair market value. So you lose that deduction because you didn't hold it for the full year. The rest of the assets other than cash, you can include the full fair market value, because if you look at the time, we have 6 years and 2 years, it's over the 1 year threshold, right? The other question was on, was it a good decision or a poor decision to donate the gold stock? And the answer is it was actually a poor decision. And the reason why it's a poor decision is because the tax filer who made the donation missed out on a $5,000 deduction to capital gains income by doing this. And the reason why is, let's take a look. Gold Corporation stock has a basis of $28,000. So the tax filer paid $28,000 cost for that gold stock, right? However, the fair market value has decreased to $23,000, meaning that the holder of this gold stock has a $5,000 loss. And you're allowed at the time of the sale, if you recognize a loss, to offset that loss against other capital gain income, right? In this case, the tax filer just donated the stock to a charity, which is a noble thing to do. For tax purposes, though, it probably wasn't the best way to handle it. The best way to handle this would be to actually sell the gold stock, incur the $5,000 loss, give the $23,000 in cash from the sale of the gold stock to the charity. So they're getting the same value, and then taking the $5,000 loss on your tax return to offset any capital gains, and that loss could be carried forward to offset future capital gains. So it's not that it was a poor decision to make a donation. It was that the donation should have been a cash donation because we had a loss, and the tax filer left $5,000 of a deduction on the table. So those were the common questions I had this week. If you have any others, please let me know after I post this video. I will be traveling on Thursday, so I might be away from email, but I will definitely get back to you on Friday or Saturday. So if there's a slight delay, it's because I am traveling on Thursday. I hope everyone has a great rest of the week. Let me know if you have any questions. And I think that that's it for the material this week. Thank you.